Thanks so much for having me. Thanks to the ladies who are here for lunchtime and for everyone for coming back. Let's see. I was going to do. Oh wait. Where's Lynn? And the little toggle thing isn't. Okay, we'll figure this out. But I was going to just jump straight into the presentation to demystifying the stock market and how to think about it in 2025. But my new friend Brett asked me if I would talk about the strategy and the portfolio a little bit. So at the risk of boring you who've already heard this today, I think I'll go over a little bit of my background. Oh, thank you so much. I think I'll go over a little bit of my background and how I started the strategy and where it came from. And I'll do the colorful version, which I had intended not to do. But I think you might, yeah, I can see, we have one person here who's happy to hear the colorful version. So I grew up in Connecticut, an hour outside of New York City, where it's very, very heavily kind of like investment banking, finance, blah, blah, blah oriented. Despite that, I knew nothing about investing. My dad's a serial entrepreneur. We had huge highs, incredible lows. Unlike the market, the lows were more sustained and the highs were more ephemeral. But I grew up with like a very, very financially volatile childhood. And unfortunately, I'm also a horse person. And my parents never paid for that. I mean, maybe the first few riding lessons they paid for, but I was on my own. So if you know horses and you want to ride, you know they go, okay, you know they need to make a lot of money. So I've always had a lot of jobs. I babysat like crazy. I had a bookkeeping job. I had a cashiering job. I took care of a barn from time to time. And one of the jobs that I loved the most was this cashiering job at this very high-end local grocery store. And I loved counting the money in the drawer. And it was like, I thought, this is great. It's on the big days, there was like $11,000 cash in the drawer, and I loved counting it. Simultaneously, or kind of, I don't know, parallel with this, I went to a very small all-women's school in Virginia called Hollins. It's down in Roanoke, and Hollins had a January term program where for the month of January, either you take a class or you study. And as you can probably all guess, I'm more of a worker than a studier. So one summer I'm cashiering, and I'm also taking care of a barn for a couple of weeks while the woman who ran it was gone. And I'm going on a trail ride with one of the clients. And I ask her to be nice, oh, Mrs. Keefe, what does Mr. Keefe do? And she says to me, oh, Mr. Keefe's the money manager. And I say to her, I love managing money. Thinking that counting the money in the drawer was managing money. And I said, do you think Mr. Keefe would like a free intern for the month of January? And she said, I don't know, I'll ask. So she comes back the next day and she says, yeah, Harry says that you can intern for him. So I'm like, this is great. But I had no idea. Oh, and this is part that I left out of the story when I told it this morning too. So at this point, this is too much information, but whatever. My parents were like completely bankrupt. I'd been shopping at the Goodwill for a couple of years. There was no money. And my mom's kind of a hippie, so it's not like she's going to help me figure out nice suits to wear to my new fancy New York City internship. So I'm on my own, and I'm going to start interning that winter at this Keefe manager, a money manager in New York City, having no idea what money management actually meant. So I go to the Goodwill. I get these 1970s Adrian Vittadine little suits. This is 1994, right? So, and I'm not joking that these were 1970s suits. So these tiny little like pillbox skirts and puff sleeves, and I, trot into New York City to be a money manager. And what I learned right off, well, I should say this too. So the hedge fund that I interned for was called Keefe Managers, and it was founded by a guy named Harry Keefe. And I promise this gets to what I do now. I'll be there in like 30 or 40 minutes. Okay. So the hedge fund was founded by a guy named Harry Keefe, who had founded a firm called Keefe, Brett & Woods. And that was a big investment bank. And Harry retired, and he got bored in retirement and started a bank and thrift stock hedge fund. So this is 1994, when all the banks started merging and the thrifts started merging with each other. And I'm 19 years old, and I find myself in New York City, and it is the most interesting place I'd ever been. And what I loved about it was it was small. There were 9 or 10 people max, and they were super smart. And they understood the world, the way the world worked. They understood the big kind of global geopolitical perspective. They understood why banks are merging. They understood companies from the bottom up. And it was really amazing. It was just smart. and it made money, which has always been a motivating factor for me. And so from there, I knew that from Hollins College in Roanoke, I was not going to become a money manager too easily. So I just interned and interned and interned. Wait, where's Doug right now? Okay, so this is so funny. In the 30 years that I've been beating around this business, I'm 49 now, and that was when I was 19. No one's ever known, ever, one of the people that I interned for until today. So I knew that if I was going to grow up and be a portfolio manager and have a real job in the investment business, I really had to hustle. So I had these great internships, and I interned for a guy named Lasso Barini, who was this terrific market strategist. I interned for a firm called Beachy and Field. And while I was at Hollins, I interned for a guy named Bob Jordan, who I read about in the Roanoke Times, called up and asked if he wanted an intern. And while I was there, I traded S&P, or we traded S&P futures. No one's ever known Bob Jordan until Doug today, which completely blew my mind and made me so happy. So I had all these internships and went from Hollins to Goldman Sachs in 1997. But at Goldman, it was kind of like trading and research. It wasn't really portfolio management. And I really wanted to be a portfolio manager. So I moved from Goldman to Neuberger Berman. And as a caveat, this sounds like a very linear, clean story. It isn't really. I think no career stories really are. And I found myself at Neuberger Berman in 2001. And this comes to the strategy. So at this point in 2001, I was on a team that was managing a very kind of plain vanilla S&P-like portfolio. And I had one client call one day, a guy named Craig, and he said, "Look, Jen, I'm 55 years old. I'm getting ready to retire, but so I need income, right? Because I know I'm too young to really retire. So I need income, but I also need growth. What can you do for me?" And so what I did was I took his U.S. stock portfolio and I changed it into still a U.S. stock portfolio, but with the objective of having this 5% or better dividend yield that Tim mentioned before. But then because it was all in stocks and not bonds, there was also growth potential on top of that. And the strategy took off. And it took off because it made sense for people like Craig, who were retiring and needed income. It made sense for people who had a trust where there was an income beneficiary and a growth beneficiary. It made sense for foundations. And it also made sense psychologically. And this is something I didn't touch on this morning, but it made sense psychologically for people who were just kind of uncomfortable with the market swings and wanted to know that no matter what the market was doing, there was this income coming to them. They found it very comforting to know that you could be in a March of 2020 at the time when times are the worst, and you could look at your portfolio and say, "Hey, it's down off, but you know what? My income's still coming to me, and it's still safe. And you know what? Next year, my income's going to be a little bit higher than it was last year." So that's the strategy that I created in 01. Fast forward 24 years later, and it's still the same strategy. Now I left Neuberger in 06. I came out to Gilman Hill. I bought my partners out in 2009. Right now, there's 9 of us all together. My wonderful colleague, Beth Ryan, is here with me. And so Beth works with clients. I manage the portfolios, I do operations and research. My partner, Greg Stanek, manages the international strategy, as well as the disciplined growth strategy that Tim mentioned before. We manage about $1 billion, and it's a really lovely business. As I was saying to Doug, we don't have a marketing person. We have no marketing because we like to have relationships with the advisors the way Doug and Tim like to have relationships with you, where you know the person and it's a deep, real, trusting, mutually trusting, and respectful relationship. So that's where the portfolio is today. The yield, as Tim reminded me, because sometimes I forget, was 6.2% at the end of the year. So cranking it out and just kind of chugging along. That dividend income grows every year by about 5% on average. So it outpaces inflation, and it's a very pragmatic strategy. So last year when the market was up 25%, we were up a little less than 10. The year before that, we were up about 10. The year before that, when the market was down, we were down a tiny fraction of what the market has done. So it's not a S&P portfolio. It's really different. And it's really just an absolute return. You get your income, and over time it grows. But it's worked quite well over the years, and it is differentiated. Okay, so thank you for listening to that. I should make one more plug too, maybe. This is something we talked about a little while ago and before this. Our international strategy does roughly the same thing. the different, we'd say international, and I think this is kind of important right now because I've had a lot of calls of people saying like, oh, you know, with tariffs and this and that, shouldn't we stay away from international? And it's actually quite the reverse. There's a lot of really terrific companies outside of the United States, like Honda Motor and GlaxoSmithKline. They're huge global companies, but because they're headquartered outside of the US, they are much better priced in the US. They have a big, hefty dividend. And I'll let, you know, if anyone wants to talk about international, I'll turn that over to Tim and Doug later, but it's an interesting space to be in, an interesting time with all that's going on in the US right now. I'm looking at it as a little bit almost about holiness. So we have this long international strategy too, that also cranks out the dividend. Okay, so enough of the commercial. Let's get into the fun part of the presentation. Demystifying market and how to think about 2025. One of the really tough things that we're in right now, that we're in a very, very, very noisy environment. Everywhere you turn, there's just noise. Actually, I was thinking about this, and I'll go back to this for one sec. But the challenge of even doing this presentation is that there's been so much noise that I've changed this presentation up until about an hour ago. And we'll get to a slide on tariffs later. And the tariff slide had to be updated yesterday afternoon after sending the presentation to Denlyn and Tim for the, hey, it's finally finished. Then we had to update the tariff slide again. And I called the office today and I said, should I update it again for the presentation tonight? And this isn't fun, this is real. We had the CEO of a company called Postal Realty in our office the other day. Postal Realty is one of the companies in the portfolio. It's this little real estate investment trust. They own post office. And that is a great business to be in because you buy these mom and pop post offices, you turn them over, lease them to the US government and collect a lot of cash. And the CEO said something that was so perfectly phrased. He said that the problem is that nobody knows how to unpack what's going on right now. And he said, I don't even know what I'm responding to. And what he meant by that is, okay, this is a guy whose family has been in the post office owning business for multiple, I don't know, his dad had the company before him, so maybe it's 50 years or more that the company has owned post offices. And this guy is as professional and knows the postal business better than the Postmaster General currently does. That's not an exaggeration, that's a statement of fact. And he says, I don't even know what I'm responding to right now. Because what happens to even the CEO of this publicly traded company is he wakes up one morning and there's a headline that says, the USPS is going to be folded into the Commerce Department. And then later that day, it turns out it's not. And he's in DC and he's talking to people in the postal system. He says, I know more about how it works than they do. And then last week, there was another headline. This is really interesting. They were announcing their earnings call. And earlier that morning, I had read a headline saying, and this is a great idea, that they're going to use all the postal workers to do the census going forward, which is a huge affirmation of the fact that through Department of Government Efficiency, post office system is going to remain. But they hadn't even heard that when they're doing their earnings call to clients. So there's just a lot of noise. And so I think about the Grinch who says, all I hear today is the noise, noise, noise. So this is different today. The reason there's noise, noise, noise is different today than it has been for the past maybe 6 or 7 years that I've been using this slide. But this part's still important too. So when we think about why there's so much noise and trying to separate out the noise to do our job, we need to think about what the motivation is. And I always say consider the motivation. Although there's a wonderful Charlie Munger quote that says, show me the incentive and I will tell you the outcome. And we need to think about how, well, backing up for a sec, ABC, CBS, NBC, Fox, and PBS. Those were the only TV stations I had as a kid. Then we got the New York Times delivered to our house and the local newspaper. Maybe the Journal came, I was too young to remember that. But that was it, right? They didn't have much competition for my eyeballs. The only way any of these businesses, right, CNN, Google, TikTok, ABC, the only way they stay in business is to sell ads. The only way they sell ads is to capture your eyeballs. And it is very, very boring. If someone like me goes on CNBC, if someone like me goes on CNBC and says the following, Tim mentioned I recently bought Conagra. if I say, today I bought Conagra for your portfolios, it has a 5.4% dividend yield. The earnings are going to grow at 3%. It trades at 6 times earnings. And I think that maybe over the next 5 years, I should have an annualized return of 8%. Like that is the biggest snore ever. You know, what's going to catch your eyeballs is if someone says, I think NVIDIA is going to double. You know, I think the market's going to crash. So we really have to think about when we hear all this noise, what's the motivation behind it? And I think it used to be a lot more about delivering actual news. And now it's about survival for these networks. And the only way they survive is to say something that's going to grab your attention and hold it. As a portfolio manager, this is very hard. And the way I'm envisioning our job as portfolio managers right now is that we're a giant sieve. And it's our job to take all these things that we hear, egg prices, crypto reserve, border interest rates, Ukraine, Middle East, steel tariffs, deportations, tax cut extensions, put them all into a sieve and shake the sieve and see what comes out at the bottom. And the things that I need to pay attention to, because it's too much, right? This is blowing everybody's brain. No one can handle it. I actually heard recently that the White House had to hire more, what are they called? Stenographers. They had to hire more stenographers because the volume of what's being said at the White House is so much that the current stenographer crew can't keep up with it. So it's not fake, like it's real that we're all hearing a lot. And so the only way we can deal with this is to shake the sieve and see what comes out. So things that impact tariffs, that matters to us. It impacts inflation, that matters to us. Taxes, economic growth, and the consumer. So we shake the sieve and we see what comes out. On tariffs, I can't remember, someone asked about this afternoon. Tariffs are so hard to deal with right now. So this is as of yesterday at noon. It's already changed, but what had been implemented as of yesterday were 25% tariffs on Mexico and Canada, 20% increase of tariffs on China. Proposed was 25% on the EU, 25% on steel and aluminum, 25% on auto. Possible was 10 to 20% on universal tariffs, tariffs on copper, semiconductors, et cetera. And so the hard part then is to say, okay, but what's the dollar impact? How does this really affect the economy? What is this really going to do to the stocks and the earnings of the companies that, that drive your investment returns? The most likely case scenario, and this is from a whole bunch of different sources and resources on how these things like mathematically work out. The most likely scenario is if there was a 10% universal tariff, that would impact GDP by 0.5%, 0.5%. The worst case, if there was a 20% universal tariff and 60% on China, it would impact GDP by 1.3%. And if there were retaliation, maybe 1.7. Now, this is all super hypothetical. And even today, maybe it was last night after the market closed, and then this morning, Trump said, okay, but I'm not going to do autos. So even the proposed 25% the 25% on Mexico and Canada, like the car part of that came off overnight. So this is a very moving target. But I think what we take away as portfolio managers is the worst case scenarios don't throw us into recession because GDP is still growing at about 2.5%, 3% a year. We don't have a shrinking GDP yet because of this. We need to think about taxes. And one of the questions that I got from a client recently is, are my capital gains taxes going to change? I think probably not. There's the thought that the Trump tax cuts from 2017 will be extended. So that's not actually a reduction in anyone's taxes today. It's just an extension of the rates that we're at, so things status quo. Yes, hopefully corporate taxes get cut. Social Security and tips being exempted maybe. Our thought is that probably these will come to pass, but it's going to be very, very, very noisy and very roller coastery between now and we find out what the final verdicts are on taxes, because there is only a narrow lead in the House, 220 to 215. We have an enormous budget deficit of $1.8 trillion and also an enormous national debt of $35 trillion. So all of that's going to come into the conversation, light the news up and create a lot of noise. Inflation is something we watch very closely. And if you can see, the Fed's inflation target is 2%. You can see, where's that cool button? Ooh, okay, look at that. You can see inflation came down from that almost 9%. It's sinking steadily, and then just in a couple months, it started to move in the wrong direction. I don't know if that holds or not. But it's in the wrong direction. And so that's something that we need to pay really close attention to. It's not telling us anything yet, but it's not a red flag, but it's, it's a light pink flag creeping up. Unemployment. One of the things that went into that sieve was deportations and unemployment, mass government layoffs. And it's interesting, we actually just got some employment data yesterday that's not pretty at all. But it was hard because, I kept getting these calls like, oh my God, there's gonna be 1 million layoffs, there's gonna be thousands, like it's gonna be terrible. And finally, I think it was last week, we got some data from Apollo Research that said, okay, the number of government jobs right now that are at risk from Department of Government Efficiency is about 300,000. Finally, a finite number, like something I can work with. Then they said, if we include contractors, like consultants and other contractors, it could be 2 or 3 times that. So let's say it could be 300,000 to 1 million. And then we can start to put numbers to that. If it's 300,000, that's 300,000 jobs on 190 million employed people in the United States. So that would be 0.2% of people being laid off. So this number, this 4% current unemployment rate would creep to 4.2%. Let's say it's a worst case and there's 1 million people laid off. So then it's not 0.2%, it's 3 times that, it's 0.6%. Then the unemployment rate will go to 4.6%, which is a lot, but it's still under the 50-year average of 6.2. It's something that the US can bear. It's not unprecedented. But these are the things, I don't have a conclusion here. There is no conclusion. It's just what's impacting the market and what we're thinking about. Where I think things start to get dicey is if people start to feel bad about this. And we all know that what does the market love more than anything? Uncertainty, right? What does the market hate more than anything? Uncertainty. What do people hate more than anything? Uncertainty. And when you're uncertain, you don't spend the way you normally do, and you're not comfortable, you're not happy. So we look at consumer sentiment, and consumer sentiment's really starting to get clocked. When was it? Last Friday. Yeah, so a week, just shy of a week ago. Last Friday, the Michigan Consumer Sentiment Index came out with this 64.7 number. You can see it's like really trending down. And the market got clocked. The market was down 1.5% following this news last Friday. Now, interestingly, consumer spending isn't actually correlated to consumer sentiment. It seems like it should be, but it's kind of technically not, or not directly. I think it's a derivative. But the other thing that happens when people feel crummy, they don't really feel like spending a lot on their stocks, and they're more conservative in their stock buying. So right now, and I'll get into this a little later, the S&P 500 is trading at a quite rich multiple. It's trading at 21 times earnings, which is almost as high a valuation as it's had at any point besides just before it went into 2022, when there was a bear market, and before that in 2001. So we've got a rich multiple, and we've got people starting to feel not great. So let's see, we will move along. Okay, now, on the flip side, we have a consumer that's remaining shockingly strong. I don't know how many of you have little kids or have had little kids, but when my kids were in kindergarten, they went to this lovely little school, and the head of the lower school was this woman named, oh my gosh, Miss Mallon. I'm blanking on her first name. But Miss Mallon said, I remember she brought the parents in for the first day, and she said, we like to talk to your kids about the power of yet. The power of yet. And she said, when they say, Miss Mallon, I can't reach the shelf, I say, no, little Bobby, you can't reach the shelf yet, right? So the power of yet. So I think where we are right now is very thinking about like yet here, and maybe the power of yet, actually in the wrong direction. But we see that the consumer is holding up remarkably well. Personal consumption expenditures in January were up 5.5% year over year. The consumer is really strong. We still have 3.9% wage growth. There's still $160 trillion of household net wealth. And even if you can't see the numbers from afar, it doesn't matter. You're looking at the direction, which is wages are still growing. They're certainly not contracting. Household wealth is at an all-time high, before we see spending is still good. So the consumer is holding up really, really well. That's the crux of it all. Does the US consumer hold up? Does the US corporation hold up? Okay, scooting into what influences the market. If we think about last year, 2024, the S&P had about a 25-26% return. And the reason was quite simple. With all the other noise, there were really two things at play. Interest rates were expected to go down. They didn't all actually go down, but they were expected to go down, and company earnings went up. And above everything else, above any administration, above any noise, above, you can think about all the crazy things that have happened, but Ebola back in 2014 or a China growth scare in 2018, all these things, what matters the very most above everything else is what happens to earnings and what happens to interest rates. So here's where we stand this year. It is still expected, and this is a little shady or a little shifty. It is still expected that interest rates will go down. And why is that? Because the Federal Reserve is still expected to cut to cut the federal funds rate 2 more times. In fact, just yesterday, that number crept up to 3 more times. Now, if we get strong economic data, that might disappear and the Fed might not cut. But at this point, the Fed's expected to cut. Historically, the interest rates that actually matter to us, mortgages, the 10-year treasury that almost all corporate borrowing is priced off of, historically, those have followed these short rates. What's interesting last year is that they didn't. Actually, mortgage rates crept up a little bit and the 10-year treasury crept up a little bit. But you can see just now, the mortgage rates are just creeping down a smidge, not meaningfully, but down from a high of 6.9% about a month ago to 6.7 now. And the 10-year treasury is pulled back from 4.6%. This is actually higher even today. This is 4.24 yesterday. It's 4.34 today. So we have the federal funds rate still coming down and signs of interest rates that actually matter to our lives just starting to creep down. That's positive for stocks. It's positive for business. It's positive for the money in our pockets, and it supports the market's valuation. This is interesting too. Corporate earnings are still expected to be up. This is an interesting number. So right now, as of right now, consensus earnings still expect the S&P 500 to grow by 16% next year. I was just showing Tim just before he came in. I was looking at JP Morgan's numbers on this. They're starting to wane a little bit. That $275 of earnings for next year, according to JP Morgan, is down to $271. That's still 12% growth. So as long as we have corporate earnings going up and interest rates coming down, that's a setup that supports the equity market. Okay. What did I do with that? Okay. The current stock market's a weird place. And I'll tell you why. There is a lot of concentration. So, have you all heard the term Magnificent Seven? Never heard that? Okay. For those of you who haven't, the Magnificent Seven are Apple, Amazon, Google, Meta. You get the gist of it. This is actually the top 10 stocks, which I believe includes JP Morgan, Berkshire, and one other, I can't remember who. So right now, this is slide from Gilman, those 10 stocks are taking up 36% of the S&P 500. This is an unprecedented level of concentration by a very few number of companies in the overall stock market. I can explain why. It's explainable, it's reasonable, but it's condensed. This is outdated. This is from my friend Edgar Denny, and he stopped updating this about a year and change ago, which is a bummer, but I think it's still really important. So what it shows you is, it shows you the top 5 stocks in the market. And so about a year ago, and they're still the same now, it's Apple, Microsoft, Amazon, Google, Facebook. What's important to see are 2 things. We can go back to the other slide. You can see that right here, the concentration of the top 10 is higher even than it was during the dot-com boom. The last time it was this high before it cracked was going into 2022. But what's interesting here, and the reason I wanted to share this, even though it's outdated, is that we need to remember that leadership changes. And so when we look back to 2012, the top 10 stock, the top 5 stocks included Exxon, Walmart, and Walmart. When we look back to 2000, before the dot-com boom and collapse, it included Cisco, GE, Intel, and Exxon. And so it's just important to keep in mind that as we hear these magnificent 7, as we hear Amazon, Microsoft, Apple, Google, we need to remember that leadership changes over and over. There's other ways that we see this extreme concentration in the market. And I thought this was so interesting. What this shows is the percentage of stocks that outperform the S&P 500. And this makes sense. Over the long run, you see within the S&P 500 stocks, on average, 50% outperformed the overall average. That totally makes sense. That's mathematically reasonable. In the last 2 years, last year, only 26% of the stocks had a higher return than that 26% that the S&P returned. The year before that, it was 27%. So that concentration is really, really narrowing. We also see excessive risk taking in the market, and this is bananas. I only saw this about a month and a half or 2 months ago now. But stocks like NVIDIA have become so popular, and I don't know if you all know the term gamified. They've almost become gamified. Now, NVIDIA is a fantastic company. It's earning a ton of money, but everyone wants in on it. And the share price has gone kind of crazy. And part of that is there are these little exchange traded funds being created where you can own 2 times NVIDIA leveraged, right? So if you're some, 31-year-old and you want, oh, geez, I missed out on NVIDIA. It was up 300% and I missed out and that stinks and I want to get in and I want to play that game. But, I'm 31 years old and I can't borrow on margin and I can't leverage it up and get really aggressive. Guess what? They created an exchange traded fund. So even though your custodian won't give you margin or the ability to leverage because you don't have the credit worthiness to do it, you can go buy a fund that's already done that for you. And we've seen this a lot. We've seen it with Tesla, with MicroStrategy, with Coinbase. So there's this excessive risk taking that we're seeing. And then we see headlines that are reminding us of this with 0-day options. With this interesting headline, more men are addicted to the crack cocaine of the stock market. What could go wrong with MicroStrategy and others as billions go in debt to buy more Bitcoin? So there's at the fringe, and this is not the world I play in. I'm 99% sure it is not the world you play in, but at the fringes of the market, there is really excessive risk taking place. Meanwhile, even as of February 28th, as of yesterday, it's 21.1 times. But this S&P 500 is still trading at a very rich multiple of 21.5 times. And you can see the last time that multiple was so high, which I mentioned before, was in 2021, going into 2022. And before that, before the dot-com boom. This, I think it gives me pause on the kind of common areas of the market. This is why you want to be with Tim and Doug, where you are not just sitting in the S&P 500, where you've got diversification. I'm sure you have balance in your portfolios, but it's an important thing to know. And again, I'll go back to the slides I had before, which is, you know what? Earnings are still growing and interest rates are still expected to come down, and that supports this. Okay, investment returns past, present, and future. It's important to remember where we've come from. And one of the kind of market truisms that you always hear is the S&P over the long term returns 8 to 10%, right? Everybody's heard that. So here's the actual numbers behind that. Over the past 30 years, the annualized return on the S&P 500 has been 10.9. 20 years, it's been 10.4. 10, it's been 13. And past 5 years, it's been 14.5. So you can see that in the past decade, there's been excess return compared to history. You can look at that a couple of different, on the one hand, it's validated. There's been incredible earnings growth. There's been incredible productivity, but it maybe has pulled a bunch forward. Now, what's interesting is if you look at the Dow, which is not weighted the same way, it doesn't have that same excessive concentration risk that the S&P currently has. The Dow is much more normal by historic averages. Only a 10.6% return over the past 5 years. Only 11%, so a little above, but not much. Getting into this year. Okay, this is not intended to be at all political, by the way. So getting into this year, I see the market, I kind of liken the market to having a battle between animal spirits and chaos. And I don't know if any of you know South Park well enough to know Butters.
Yeah.
Butters. Does anyone remember the episode where he was Professor Chaos? Okay, oh darn it. I was so like, oh gee, I hope this guy. So there's this one hilarious episode where Butters decides to be Professor Chaos. And all he wants to do is like, create chaos. You know? And I couldn't think of any other visual. And then I'm like, okay, maybe this looks political. It's not intended to be that way. It's just the only chaos visual I can come up with. So right after the election, you saw the term animal spirits, which by the way, my husband hates jargon, hates stock market jargon, and hates the term animal spirits. But you heard that come up a bunch. And you saw the stock market run up almost 6% in the aftermath of the election. And then once Trump started announcing nominees for the different cabinet positions, things got a little chaotic and people got worried and you saw the market sink. And then animal spirits took over again. And on February 19th, the market reached an all-time high. And then in the past 3 weeks or 4 weeks, it's become chaotic again. And the market sunk. It's actually down about 1 and change percent up here. So I just really look at so far in 2024 as a clashing with no outcome on is it going to be chaos or is it going to be animal spirits? What we're seeing that's really interesting year to date is we're seeing real leadership change between what we had last year and what we have this year. So by way of example, last year the S&P was up 25%. The equal weighted S&P, so not the one not concentrated in those 10 names, was up only 13%. This year, the non-concentrated version is up about 3. The S&P is up 1.5. So the non-concentrated is double. I'll jump down lower. You see things like last year, the energy index, for example, was up 5%, where technology was up 36. This year, energy is actually up 6%, technology is down 4. You can see the same thing with healthcare. Last year, healthcare was up 2.6, and communication services, which is really just Meta and Google, was up 40. This year, communication services only up 2, healthcare is up 8. So all these areas that underperformed last year, right? They were still up, it was still a good year, but all these areas that underperformed last year are starting to outperform this year. I'm going to skip away from that for a second. When we think about going forward, one of the things that we try really hard to do at Gilman Hill is like check the emotion, check the bias, right? Like just think about what the long term brings you. And so what we do to do that is we look at some of the big banks, they'll put out these capital markets assumptions. And they say, hey, you know, given growth rates, given valuations, given this, given that, here's what we expect. JP Morgan does the best job of anybody. But we look at as many as we can. Invesco had, for the purposes of this, the also most useful. And what JP Morgan says is, this is interesting, they said going into 2024, we expected the long-term return on US large cap stocks to be 7%. Going forward, and I think this is like 3 to 10 years, right? That's their long-term 3 to 10 years. And I think going forward, this year they're saying we expect it to be a little lower. Long-term, we expect large cap US stocks to be 6.7. Invesco is more conservative, they're saying 5. Interestingly, when you drop down to international stocks, JP Morgan is quite more positive than the US. The UK, for example, they expected 8.6, now they expect 7.8. Invesco is only 6.5, but also higher than their US expectations. So the reason I wanted to bring this up goes back to this slide, where you see that last year, you know, for the last 5 years, the market's returned 14%. And I had a call with a client yesterday where he was saying to me, look, if we want to retire, soon, you know, we can just count on your portfolio to keep delivering 10%. And I said, no, I don't think you can. You know, I don't think you can. I think you can definitely count on a positive return, particularly over the long run, but we've out-earned. And when we think about going forward, the expectations by the big banks, which may or may not be right. And I see my friend Bob Everly in the back, who's like the king of market history. And he's going to say like, all this is garbage. It's true, right? All of these assumptions, no one's ever right, but I think they're directional. And so I think as we think forward, I think it's completely reasonable, even with like the turmoil or chaos or fluctuations that we have this year, I think it's completely reasonable to expect long-term positive returns. There's a lot of really good stuff going on. But I don't think we should expect returns at the same level that we've seen them at for the past 5 and 10 years. So what to do? Okay, here's a slide that I put in the presentation about 20 minutes before we started. I used this in the ladies' luncheon, and I thought it was so fun I should share it with everybody. What's up here? And you can't read it from here, but if you want to email, you're welcome to it. Are quotes from some of the best investors of all time. So we have things from Warren Buffett. The stock market's a device for transferring money from the impatient to the patient. Rob Arnott, in investing, what's comfortable is rarely profitable. Jack Bogle. Oh, your neighbor, Bob. Jack Bogle. Was your neighbor. Your success in investing will depend in part on your character and guts, and in part on your ability to realize that the height of ebullience and the depth of despair, like that this too shall pass. John Maynard Keynes, markets can stay irrational longer than you can stay solvent. John Templeton, the 4 most dangerous words in investing are this time is different. Charlie Munger, the big money is not in the buying and selling, but in the waiting. And what's important here is these are the best investors we've ever known. These guys made billions of dollars. None of this advice is about when to buy a stock, how to allocate a portfolio, whether you should own venture cap or private equity, what kind of stock to buy. All of this is about behavior. And in this time where I started off, in this time of a lot of noise and frankly discomfort and trying to figure out if it's animal spirits or chaos, I think the best thing we can do is behave well. This is a slide from JP Morgan. It's a little dated. Don't know why they're not updating it, but the point remains the same. Over the long term, and I think probably a lot of you have seen this, over the long term, the average investor has shown a return of 8.7%. A simple 60-40 portfolio, so 60% stocks and 40% bonds, has had an 11% return. And the S&P 500 has had a 16.8% return. And the reason for this, the reason the individual investor has had a lower return is one reason, and it's behavior. And it's because they've freaked out when it's March of 2020, or they've freaked out right now. We live in Connecticut. It's a pretty blue area. We have a lot of clients who, I actually have, it's not a client, it's a friend, who seriously texted me and said, I think I want to live in a mountain, inside a mountain in Switzerland with my gold. That's a really, all I know is that's a really bad idea as an investment. I mean, it's a bad idea for a lot of other reasons too. But I think the best thing we can do is behave well, carry on, know that the market returns is annualized 8 to 10% over time. It might be a little lower for a while, but it's still positive. It's still better than bonds. Doug said this is a slide that you guys see often, and I actually seen it first on Facebook a long time ago from one of my Facebook moms. But I think it's perfect. I try and share it as often as I can. And ideally we'd earn 9% in the market on an annualized basis every year. It would never be up 18. It would never be down 2. It would just be 9% a year. But reality is there's up, downs, and sideways. And when I first saw this years ago, I thought, boy, isn't that funny? How that bottom graph sure looks like a picture of the S&P 500. So really, I think this is the best thing we can do. My partner Greg says, when times get tough, what do you do? And when times get tough, you follow the process. And what's the process? The process is to strip out the emotion, to not market time, to put one foot in front of the other. For us as portfolio managers, it's to revisit the assumptions of every company in the portfolio and say, okay, how does it hold up in this environment? Is my investment thesis still intact? And then to look at it from the bottom up. Are the earnings still there? Is the macro economy still supportive of it? Can we get through this? And it's just put your head down, follow the process, march along. So with that, I would like to open up to questions. If anyone has any, I can say questions if anyone has questions too. As the ladies at lunch know, I can tell stories if you want stories. Yes.
Question about when you were talking about unemployment,
Mhm.
and that current unemployment was less than, I forget what the term was, you know, the average or whatever. I think that some of the changes to federal employment is concentrated in very specific areas in a way that will cripple very important services to the public. So I think that that has a disproportionate, may have a disproportionate impact. It's not like employment is.
I think there's some, like, what are the knock-on effects, right? What are the knock-on effects? So what are the derivative effects? This is really tough. And so a couple of things on that, and this goes to a lot of, we have no idea right now. You know, we really don't, and you just have to see it play out. But what I could have said in addition to this is the following, which is, of those 300,000 employees, the average salary is $106,000 a year. That's 320 billion. Oh yeah, no, follow me through for a sec. Yeah, follow me through for a sec though, because I'm getting there. That's $320 billion a year. Okay, just total wages are 11.8 trillion. But of those high end, right? And this is the question I was asking myself a year ago was, if AI replaces programmers and they're earning a lot and those programmers are all skiing at Vail, right? Because they're rich and they live out west, is that going to hurt the stock of, they were like, are they going to spend less on ski passes? And so I think the question is, of that 320 billion of income that's at risk, how many of them get reemployed? You know, let's say half of them get reemployed, and now there's 150 billion of lost wages. Like, how does that get spent differently? You know, and does it hurt DC real estate? Right?
My concern is absence of the services that they were providing under the auspice of the federal employment.
Yeah.
Not whether they're employed in some.
Oh, I think how those guys spend it. I don't know. And nobody knows on that. And this is what's so hard. So maybe to kind of answer that a little bit, but it's all I don't know. You know, all of this is why I said that power, like, we don't know, you know, it's all up in the air. But one of our clients who I talked to yesterday is 43, 44 years old. He is a pulmonary researcher through an NIH funded program in Philly. And if he can't, and so that funding's gone, right? If he can't get refunded by July, his lab closes. Is this kind of where you're going? And like, what are the knock-on effects from that? That's the thing. Any of these, like, where you start pulling at the thread, like, we have no idea. And for this guy too, there's a really good chance that funding comes back because he's doing really important research. But we're in this weird early stage where there's no knowing, you know, and I don't know, and no one knows yet. There was another thing, that I shared on a client call last week where, you know, the Doge cuts. They're like, okay, it's 55 billion, or they say 55 billion, but when you go on the website and you add it up, it's a third of that. Like, no one knows any of this right now. And I think that's why you see the market trading down, because it's creating increased uncertainty. So what's getting cut, how it's getting cut, just no one knows what then refunds, what doesn't refund. I was shocked this weekend. I took my kids to Staples to get their TSA things. And I just presumed, which is a little bit of this, that like that had been affected. And then I wasn't going to get their TSA things for, I don't know, like a year. And I got them in 3 days. So we don't know any of what's really being impacted yet. It's really hard. But as a portfolio manager, I'm trying to play out if there's a well-educated 150,000 who now aren't earning, you know, does that hurt private schools? Does it hurt, you know, okay, here's an example. So what we saw is people have downgraded to Walmart, but it actually, how is this? But it didn't help Dollar General, right? So, and I can't remember the exact like mechanics of this. So like, in a weird way, higher end people losing money helps Walmart because they downgrade to Walmart, which drives Walmart sales. But then the low end, like the even lower end than Walmart crowd is so constrained that, it's negatively impacting Dollar General. So there's just anything on, there's not an answer to that. Any other? Yes.
Regarding the housing market, not commercial, but residential buying and selling housing, what is your take on that?
So here's another, I have no idea, but I'll give you an example of where we stand with it. So if we go to, remember, interest rates, wherever interest rates were. Okay, so we know that the housing market's really tough right now and things aren't moving. I mean, there's some areas where they are, but things aren't moving because it's too expensive to refinance. Everyone has these 3% mortgages or 3.5% mortgages. And with the 30 years still at 6 3/4, you're just better to stay in place. So here's how it kind of complicates. Tim had mentioned we own Whirlpool. We own Whirlpool, and it's been a loser in the portfolio. When we bought Whirlpool 2 years ago, it was with the investment thesis that obviously mortgage rates should come down. The Fed was going to start cutting, interest rates should come down because they always have followed, and they haven't. And so what we've done now is we've said, okay, I'm sorry, what happens is once houses start moving, people move in and they get new washing machines and dryers and appliances, and it benefits Whirlpool. And it's a pretty direct correlation. But you need the housing market to work for Whirlpool stock to work. So what we've done is we've pinned our calendar for July 15th. And we're saying, look, if mortgage rates haven't come down by then, and if we haven't seen any movement in the housing market by then, we're going to consider this like a ruined investment thesis. And we're just going to have to sell the stock at a loss. But the point of me saying that is this is another, nobody knows. Because all times in history, when the Fed cuts rates and the federal funds rate comes down, the mortgage rates follow. But this year they haven't. And they're not quite following yet. So it's really hard to tell. Sorry for all these non-answers. Who else wants to ask a question with a non-answer possibility? Yeah.
So in the beginning, you mentioned international markets. So with a lot of tension in the US market, what are some strategies you implement when looking into international funds or markets that kind of tie into US policy going on right now?
Okay, so when we construct portfolios, we don't do them regarding US policy. We always look at a company really from the bottom up. So I'll give you an example here where we want to be able to say it doesn't matter at all, but US policy is. So for example, the last company that we added to the international portfolio is Honda Motor. Right now, we all know Honda, so this is easy. There's so many interesting things on Honda. So as we're thinking about the tariffs, right? Turns out far more so than Ford, Honda builds and produces in the US. Actually, Mercedes does too. Mercedes actually exports from the US. They build so much here. So Honda has very little cross-border transactions compared to their domestic peers. But more importantly, you have this Japanese company that's got 50% of the value of its market cap sitting in cash on its balance sheet. And it turns out that Honda, their biggest sales is actually motorcycles to emerging economies. So as you have these huge populations all throughout Southeast Asia, coming up into the middle class, they're buying Honda motorcycles, and we don't think of that. And there's no tariff exposure whatsoever right there. So we look for things that will do well regardless. And that's true for all the portfolios, but when you look internationally, things like that have been overlooked. And simply because they're not headquartered in the US, many international companies haven't run up with that, US stock market. And so they have a much lower valuation. So we really look at things individual, one-off. We don't make country bets, we don't make sector bets. We just try and pick off great companies. Anyone else? Fees for you? Let me talk about compounding fees. No, I'm just kidding. As a joke, to talk about compounding fees. It's one of our favorite conversation topics. Okay. Yeah.
Yeah.
I know these things. He knows these things.
The average what? The average interest rate is 1850? For what? The 10-year treasury?
Passable savings.
Let's do 10-year treasury.
Oh, yeah, I mean, when I was a kid in the 60s, That's the 1960s. You could get 5% on a fast quotation.
You know, and it's funny because when I started the equity income strategy in '01, it was 5% on the 10-year treasury. And I think what you're getting at is we're still at a very low level.
5%, 6%. So we've just been so spoiled in the last several years of 0% interest rates for all reasons. The real estate question, things will normalize. People will start selling their houses again. Things will change. Right? Start to get used to the fact that 5%, 6% mortgage is kind of the norm. And I'm going to say for a lot of people in this room, probably experienced 14% interest rates when buying your first house, right? So that's in the 80s. That was on the extreme. So we're at normal rates.
And to that point, you are starting to see some real estate transactions creep in where people are just giving up on waiting. But this is a little bit of a yet for me too. All of the things like that are still so new. I don't want to commit to it being a trend. Just say, oh, okay, my whirlpool will work out, even if rates don't come down. There's just little things that are tickling and trickling, you know, where the consumer needs to be watched, manufacturing needs to be watched, sentiment needs to be watched, you know, housing and interest rates need to be watched. But this was a particularly hard presentation to set up and give because there's so much uncertainty and ambiguity. Yes?
What's the possibility, the cost of the concentration of technology, large percentage of the market? What's the possibility that tech bubble blowing up?
Yeah. If you think of it like '01, it's extremely low. I think if you think of it even like 2022, where we saw those magnificent 7 down about, what was it, 40 or 50% on the year, I think that's low too. I don't think it's to that magnitude because these companies, the valuations aren't that crazy, right? You have most of those magnificent 7 trading between 21 and 32 times earnings, which is high, but it's not nosebleed territory. And they have spectacular earnings growth ahead. They have Microsoft is one of the worst, or maybe Apple's the worst. Microsoft's one of the worst, where it only has 12 to 14% earnings growth ahead. Now it's trading at 30 times, but that's still reasonable. So my gut, and this is just my gut, tells me, well, hold on, there's one more important thing. The other important thing on that concentration is that, and Beth and I see this all day, every day. We review portfolios and people come in and they'll have $500,000 in NVIDIA, you know, $1 million in Apple, and the cost basis is 0. So to make it worthwhile for those shares to be sold, you need to expect a decrease in excess of the taxes that you pay. Usually the taxes are 25 to 30%. So to make it worth it, you need to expect them to go down 25%. So you have this huge base of holders. So I think when we see things like NVIDIA down as much as it is in the last few days, I think it's that fringy kind of area that's beating the shares up at the margin. But my gut tells me it's more of a leadership change than a fall off a cliff. You know, maybe they just plateau and grow into the earnings. And maybe it's more like what I showed in that slide of year-to-date returns where, you know, you see the S&P up 1.5 and the equal weight up 3, you know, versus the crazy divergences of years past. I think there's a way we could very reasonably get out of it without them blowing up, but just, you know, just a plateau. Yeah.
You shared a screen about a group of high risk investments that are coming into the market that people are going into. Are you including things like cryptocurrency in that as well? And how is that affecting the normal plays that you would be making in the stock market?
Okay, so on that list of quotes, there's that John Maynard Keynes quote that says the stock market can remain irrational longer than you can remain solvent. And I told the ladies today, I have my own version of that, which is the stock market can remain irrational longer than you can remain sane. So I said to Tim before, I'm like, no one hates MicroStrategy more than I do. I hate MicroStrategy. And what MicroStrategy is, for those of you who don't know, is it's a company that's essentially bought and leveraged Bitcoin. And then people come in, and I like to call them players, I don't mean real investors, and they come in and they use leverage and buy more MicroStrategy and just run the shares up. But there's not a way to analyze a company like that and say, okay, the future value of what they earn is this, therefore the share price could be that. So it makes me pretty crazy. I think it doesn't really impact what I do, but it can impact the fringes. So if you think back to, and this might be a little esoteric, but if you think back to 2021, there is this exchange traded fund called ARK Investments. And do you remember this? Okay, ARK was run by this portfolio manager named Kathy Wood, and had all these like super innovative, like the hottest of the hot stocks. And you saw it run up like crazy. It was just a hockey stick graph, and everyone who's in it was like, oh, these are the companies that are totally going to change the world. They're so pioneering. And no one paid attention to valuation, and no one paid attention to cash flows. And then it totally collapsed. And so what you see is those kind of speculative, highly concentrated fringe areas, like they impact the market, but they don't derail the market. So, they might have dragged the multiple, maybe without them, the multiple would have been 19 times, but they kind of drag the overall multiples higher because there's, some of the FOMO and some of the excitement leaks into the broader market. And then when it comes out, it kind of hits it, a little bit. It doesn't derail, but it does. I'm not doing a great job explaining it, but to me, it's just like the fringes impact the overall, but they don't derail it. So, is that kind of what you were getting at, or?
I think so.
Okay.
At any given moment, there's something that's going on. It's to be nuts. And the cryptocurrencies and your fringe things falls into that area, and it's very nuts. So it requires me, I feel, to be a little bit more conservative. But then again, I don't want to be so conservative, I'm going to miss the boat.
Right. I had an interesting conversation the other day on crypto. And it was with this client who I mentioned earlier. So I should have said something before, but I was talking to a client who's interesting, who's quite wealthy. And she feels, I was on the phone with her husband, and her son, and she feels constantly poor. And I meant to say this before, but I said, that's called bag lady syndrome. And it's very common. And if you want to Google bag lady syndrome, it's a real thing. But the son had taken $300,000 of his mom's inherited IRA, bought MicroStrategy, which was his version of a play on cryptocurrency, and it ran up to $2 million. Now it's down to $1.3 million. And they asked me, like, should we hold it or should we sell it? And I said, this is it's like the questions that we're trying to answer tonight. It's really hard to say, because when I was in business school, I went to Columbia Business School, and we had this great, amazing class that was called Applied Value Investing, or maybe it's just, Applied Value Investing. And they had portfolio managers from around the country come in every Tuesday and Thursday and speak to us. And there was this great guy, Mason Hawkins, who runs Southeast Asset Management. And he came in and he said to the whole, 120 super nerds in the room, he said, what are the different asset classes you can invest in? Where this comes back to crypto. And people with stocks, oh yeah, you're so smart. Stocks, good job. Bonds, oh yeah, you're so smart. Derivatives, no dummy. A derivative is just a derivation of a stock or a bond. Real estate, well, is it a debt investment or an equity investment? Because that's really just a stock or bond. And this goes around and around. And he says, look, there's only 3 things that you can invest in: cash, stocks, bonds. Anything else is a speculation. So when people were raising their hands saying gold, no, it's a commodity, it's a speculation. Coal, no, it's a commodity, it's a speculation. And that's the thing with the cryptocurrencies, is there's no intrinsic value. People can say there's scarcity value, there's this, there's that, but there's no way to say my share of Bitcoin will earn $4.40 next year and $4.50 the year after that, and then say the net present value. Like, it's a speculation. And you are beholden to other people's emotions, which is, why it can go up and it can go down. And I don't know how to guess that. And I said to the son and the mom, I said, I'm an investor, not a trader. And those are 2 very different skill sets. So when I'm looking at it, I'm looking at what it's going to earn and what it's worth, and can I buy it at a discount, and what should I earn in the future? But when you're buying the cryptos, you need people to feel good, and to want to own them. And that's why over the weekend, Bitcoin had traded down to about 80,000 a share. And then I think it was Sunday night, maybe, Trump said, the term crypto reserve, and it ran up 14%. And by Monday morning, people realized, okay, so how do you create a crypto reserve? You need to buy cryptocurrencies. And if you want to buy $150 billion worth of cryptocurrencies, and we have a $35 trillion deficit, who's going to approve? You think Congress is going to say, yeah, go, like, here, just throw it, we've got Doge trying to cut expenses. Who's going to approve that expense? Might not be likely. So by Monday morning, that set in and they traded back down to 84,000, but it's very speculative. So it's very hard to manage and hard to think about, at least for me as a really kind of old school fundamental investor. Yes.
Yeah, as an investor, do you look at the IVR at all? Like 20, 25, 30%?
Yeah, so IVR is one of the ETFs, right? Which one is that? Oh, okay, thank you. So the answer is no. I am a very one-note portfolio manager. So at Gilman Hill, we have the 3 strategies, right? We manage an equity income strategy, which is a 30 to 35 stock portfolio that has dividend stocks, an international strategy, 30 dividend-oriented international stocks, and a disciplined growth strategy. So that's it. So what Tim and Doug do is they hire Gilman Hill to be part of their client's overall allocation. So if you work with Tim and he said, look, I've got, $1 million, how do we allocate it? He might say, well, how much income do you need? Let's give that part to Gilman Hill. Do you want to do the IVR? Like that would come from the allocation, not from the stock picking side. That's me. So. Yes.
I don't understand your, what do you call it, the dividend income fund product versus just the, straight stock market index fund. So what, if I understand it correctly, you find companies that have give a dividend, and regardless of maybe the volatility of the market or whatever is kind of over there, you believe that you'll find the companies that give dividends, and that's how the money is made on that product. Is that
Right,
correct?
that is correct.
Okay.
But I think your next question would be like, why wouldn't I just buy the S&P 500 and sell parts of it when I need the income? So I just finished writing a book called Dividend Investing, which is about dividend investing. And it's very small. It's on Amazon and it comes out on April 8th. But one of the first things that I do in the book is say, look, this isn't for everybody. And that is the question. If you're retired and you need $50,000 a year and you have $1 million, either works. You can sell off $50,000 of stock a year and get that, or you can have the portfolio generate the income. And over the very long term, those returns are roughly the same. So it's very psychological. And what we found is that the dividend income brings like huge emotional comfort for people, so that when you are in the worst of times, that income's coming to you and you don't need to sell. But there are a lot of people who are totally comfortable doing it otherwise. Yeah, and that's perfect. And there's one of the great quotes. Oh no, I put it at the end. Hang on. One of my favorite quotes is this. Where is it? This Michael Burry thing, which is if you were going to be a great investor, you have to fit the style to who you are. I told you about. I grew up in a very financially volatile childhood, right? And it is no mystery why I'm a dividend investor. Like I need to know that income's coming no matter what. My brothers are not that way. And they grew up in the same house, different times, but they're just different. They would not mind letting it run and just selling it off. And so you do what suits you, and whatever keeps you comfortable, behaving well, that's what works. And we were debating earlier, active management versus passive ETF. I'm an active manager. I can make a strong argument for an all ETF portfolio too. Like it has to suit the person. And if you get it right, then you behave well. And good behavior is probably the most highly correlated factor there is to investment success. Maybe not even probably is the most highly correlated factor to successful investing. So whatever works for you, you do. Yes.
I identify much with your background story. I come from criminal parents, and I definitely understand the volatile situation that can come with coming from entrepreneurial.
Yeah. Yeah.
Right. So, as a person that is moving into investing and finding her own footing within investing, I hear you talk a lot about the feelings and the emotional standpoint behind investing. So I'm interested in, I know that this is Women's History Month too, so thank you so much again for coming this month. And I kind of just want to know even more into that empathic view of investing. What would you tell your beginner self starting out?
Yeah. So it's interesting. I can't remember, Dylan, where is Dylan? Oh, okay. Who came up with the first ideas for the women's group presentation that I was like, no, let's not do that one. Can't remember, but someone on the attorney team came up with ideas. And one of the ideas was investment wisdom from the best female investors. And the reason I didn't do that was because I couldn't find it. And when you look at this slide of all the best investors, there's no women on there. And so what I've done is I'm actually working on a second book, which I'm super psyched about, which is going to answer this question for you. So what I realized is I always have girlfriends ask that question. And one of them is my friend Meredith, who's my age, who 2 years ago, her husband at age 50 dropped dead of a heart. And Meredith is super, super, super sophisticated as a person. She does development for this enormously famous foundation in the UK. Like she hobnobs with all, the British royalty. She's development at Harvard, but she just doesn't know investing. And I have these friends all the time and they're super embarrassed. And they're like, Jen, I didn't even know where to start. So what I'm doing is I'm asking, and everyone's on board, and the publisher thinks it's like the best idea ever, and I bounced off the CNBC and they think it's the best idea ever. But I'm working on a book that is going to have 25 of like these awesome female investors answer that question. Because everybody has a little bit of different information, different perspective. So I'll tell you what my chapter is going to be on. My chapter is going to be on develop vocabulary. So in the women's group presentation that I did this afternoon, I really focused on compounding. Because I think if you can each year, like accumulate 1 or 2 investment terms, you've got a long horizon. Even if you're starting at age 60, you've got a long horizon. If you start investing at age 60, you've got 20 years, maybe 30 years, hopefully 40 years. If you get 2 terms a year that you really lock down, you're gonna have 50 or 60 really smart investment things to say in pretty short order. My friend Beth Spurry, who's doing a chapter, hers is on cash flows. And it's if you need to know what your cash flows are. And this goes a bit to your question, right? If you know what your cash flows are and the portfolio can always cover those, you're okay. And you don't need the portfolio to beat the S&P. You just need the portfolio to cover your cash flows. So hers is on focusing on cash flows. My friend Karen's chapter is going to be on that you didn't miss the class. Now Karen's as famous and high-flying, high finance as they get. And she said she constantly has her girlfriends come to her, I feel like I missed the class. She's like, you didn't miss the class unless you're in this weird, tiny little nuanced career that we have. There's no way to know this stuff. It's about not missing the class and just trying to read. I think reading is a huge thing. One of the books that I mentioned before today is Psychology of Money by Morgan Housel. If any of you haven't read it, get it, order it. He does a terrific podcast, but The Psychology of Money is an extraordinary, extraordinary book. It's not really investment oriented, but it's so important. It just makes you it sets you up to be a good investor. So I'm trying to answer that question, but everyone has a different tidbit. Mine's vocabulary. Okay, anyone else?
Go back here.
Yes.
You mentioned this a couple minutes ago about investing $1 million in an equity dividend fund will yield $50,000 a year income versus $1 million in the stock market. And you kind of said it all kind of evens out in the end.
Mm-hmm.
So you're really, when you say even out in the end, you're still really making kind of the same amount of money on those 2 different scenarios.
Right. over the very long term. And this is part of the challenge of what's happened in the past 5 years, where you see, for example, the S&P and the Dow diverge, but you've seen the S&P diverge from everything. So if you cut the past 5 years out and you look at, a value strategy versus a growth strategy and a dividend-oriented strategy versus, the broader market, they all have roughly that same 8 to 10% return. Over the very long term, almost everything mean reverts and kind of gives you this 8 to 10%. So over the long term, and I used to say this to clients up until the last 5 years, I'd be like, take what, pick what you want. If you're going to get 8 to 10% and you invest with me, 5 of that total return is going to come from dividends and 3 will come from appreciation. If you put in the S&P 500, 1.2% will come from dividends and the rest will come from appreciation. It used to be very even. The past 5 years and 10 years have really like gunked it up. But if you carve those out and go to further market history, yeah, it really was quite like for like.
You see that same trend going forward?
I don't know. I mean, logic, it is. And part of me saying I don't know is I know how insanely conflicted I am in being the one to answer that. Another famous Charlie Munger quote is, to every man with a hammer, the answer is a nail. Here, the solution to the problem is a nail. And it's like, to Jenny Harrington, the solution to everything is a dividend. so I feel quite conflicted. But as a market historian, if you believe in mean reversion, and something else Tim and I were talking about that people aren't really paying attention to is the rate of earnings growth. So when you look at those top 10 stocks and you go back to this page where you see that leadership trades off, the earnings growth of those top 10 stocks has been extraordinary. But going forward, like I said, Microsoft's earnings growth rate is like 12, 14%, down from 20. NVIDIA's was 78% this past quarter, down from 100. So you see them slowing. And so if they're reverting to the mean and the share prices revert to the mean, then in theory, we should normalize. And you see here, for the most part, the top 10 in the market aren't wildly outpacing the rest, but then you get these kind of peaky periods where they do. But we're coming off of, as you can see, an extraordinarily extreme peaky period. So presuming the S&P 500 or the investment world, all 6,000 or 7,000 publicly traded US stocks go back to a more normal trajectory, then yeah, it should regain that. But it's a weird, hard time to make predictions in.
Yeah, you said the last 5 years kind of gunked up. Is that just because of the COVID era? Or
Not really.
What drove that to be gunked up?
Yeah, no, really, it's gunked up because the top 10 stocks in the market have had earnings growth that have eclipsed. This isn't the right chart to show. It's actually in the JP Morgan report that's separately on there. But the top 10 stocks have had earnings growth that have so dramatically eclipsed everything else out there. Not just the other 490 stocks in the S&P, but really the 6,000 other stocks in the market. So they've sucked up all the wind, they've sucked up all the investment dollars. They've distorted what returns look like. It's interesting if you look at, and here's another thing that you can all download for free. But JP Morgan, if you go to JP Morgan Guide to the Markets, they have fantastic information that's just free for everyone. And one of the things you see is that the valuation of those top 10 stocks is about 30 times earnings. Everything else is about 18 times. Everything else is kind of behaved normally, but those top 10 are the reason the S&P is up 24%. So the rest of them are up 13%. The S&P is up 25%. That's what I mean by gunked up. They've made returns look bigger than they are, but really it's because you think the market's up 24%. The reality is 10 stocks last year were up 40%. All the rest, it was 20 or 40 or 30 or 40%, and all the rest were up 13. That's what I mean. It's kind of distorted. So it's a tough period to be macro and like geopolitically looking. It's not that hard still. I think at least it's not that hard still to be a portfolio manager, where from the bottom up, I can look at a Conagra or I can look at a Honda Motors and say like, yeah, this thing has a lot of cash. By the way, what I didn't say on Honda Motors is They have a 5.7% dividend yield, the 10% free cash flow yield. Trades at, I think, 10 times earnings. You know, it's kind of easy to invest if you're small and granular from the bottom up, and you can just pick off individual companies that you know have a nice return ahead. If you're playing, you know, should I be an equal weighted S&P, you know, or market cap weighted S&P, like that's where things I think get hard.
If you take those top 10 out, you said over the last 5 or so many years.
Yeah.
The others are averaging around 13%. Is that pretty consistent over time? And I know that.
No. I'm debating if I can easily, without screwing it up, flip to the slide, because I actually think I have it almost right there. The answer is no. It's really been the past 5 years where the top ones started outperforming so dramatically. And you can kind of see it right here. You see this blue line? The blue line is the market cap share of the top 5 companies. And so when they were lower, under 15%, they kind of had a more reasonable impact on the market. That means the rest of the market was performing more reasonably with it. And then you see here in 2018, 2019, they really start to break up. They start taking all the air out of the room. Or you can see it here, where up until 2023, you still had on average the companies in the market outperforming the overall market, half underperforming, netting out to see what the market was. And just the last 2 years, it got extra crazy with only 26 and 27% of the companies outperforming the market, which means those that outperformed really had to outperform to drive the returns up as much as they were. I can show you that slide after, or you can seriously just go on to jpmorgan.com, just type in JP Morgan Guide to the Markets, and you'll see it, and you'll be like, oh, I see that exactly. They have a great visual for it. Okay, anybody else? All right, thank you all so much.